You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music means we are back once again for TWIFO This Week in Futures Options, a program where the name pretty much says it all. We're going to break down all the action in the world of futures options. My name, of course, Mark Longo from theoptionsinsider.com. Remember, if you like what you hear, do throw some stars, some ratings, some likes, whatever your platform allows you to do. The show is pretty much available on just about every platform, including the app stores. So if you want to leave a rating or review there, don't leave questions in those places because we tend not to get to them in a timely manner. Hit us up on the various social medias or questions at theoptionsinsider.com if you want to get a timely question in. But we do appreciate your stars and ratings. It helps new folks continue to discover the content, and there are new folks discovering these markets all the time. And of course, if you personally want to discover even more content, who can blame you? A lot of great analysis being done in the world of futures options on our pro Q&As all the time. Only one place to go to get access to all that fun and a whole bunch more. theoptionsinsider.com/pro, or for you really cool kids, /secret club. Check it out if you'd like to learn more. As we learn who's joining us on the old CME Group hot seat today, I'm pleased to welcome back our old friend, Mr. Rich Excell, the assistant professor of finance over there at the University of Illinois. Mr. Excell, welcome back to TWIFO, sir. It has been too long.
It has been long. Good to see you, Mark, or good to hear you.
I say, if you see me, then you've planted that bug in my studio again, haven't you, sir?
Yeah, I have.
All right. With the team assembled, let's dive right on into the movers and shakers report.
It's time to find out what's rallying on the light side and falling to the dark side at CME Group this week. It's time for the Movers and Shakers Report.
All right, everybody, welcome to the Movers and Shakers Report, the portion of the show where we break down everything that is lighting it up to the light side, a.k.a. the upside, and to the dark side over there at CME Group this week. If you want to see this report for yourselves, it's one of the few premium reports you can get access to from Bantix. Just follow CME Group. Most of you probably do on Twitter, or follow us. We tweet it out as well right before showtime. Again, if you want to get access to the full panoply of offerings over there at Bantix. Head on over there, bantix.com, bantix.com, and then click on the free trial link. I think you're going to like what you find. We really do just scratch the surface. It's just one report out of dozens upon dozens in there that we use on this show. So go check it out over there, bantix.com, the place to go. If you did so, you would see that this week, probably not surprising, skewing a little bit to the dark side. I would say 85-15, 80-20, somewhere in that range, red versus green, even though we do have a nice pop percentage-wise to the green side. In fact, our biggest percentage mover this week is to the light side. But aside from that, not a ton of green on the screen this week. But that said, Mr. Rich, you are our guest. So you decide where we start. Should we start to the light side or to the dark side, sir?
Mark, I guess we should start the light side because, like you said, there's not too much that on the light side, so it would be interesting to see what's working.
We could do it in 2 seconds. All right. To the light side we go. Number 5, we're starting in the ags, the esoteric side of the ags, listeners, the dairy in particular. Our old friend Class 3 Milk making it back on the Movers and Shakers report, this time to number 5 to the light side, up 2.1% this week. Number 4, staying in the ags, we're going to oats, up nearly 4% this week, 3.92% to be precise. It was number 4 in the other direction last week, off about 2.5%. So getting back more than it lost last week. Again, before you get excited, it had roughly 15 contracts on the tape. So not a ton to be parsed out there. Number 3, still staying in ags. Got a little bit of a theme here. We're heading out to soybean oil, up 5.24%. Number 2, also still staying in ags, but again, getting esoteric, getting into the softs. One of our old friends, one of our frequent offenders, I should say one of our former frequent offenders, because it hasn't really been lighting up the tape much the last couple of months. It's lumber. For the lion's share of the pandemic listeners, lumber was found in our top 5 in either direction just about every week. This week, it is coming in at number 2, up 6.97%. So there's one of our 3 frequent offenders. Let's see if we can find the other 2. And spoiler alert, we do. Number 1 to the light side. I told you about our largest percentage gainer this week. That comes courtesy of the energy complex, in particular nat gas, up 17.37%. It was also number 1 to the light side last week, up 8.77%. So a banger couple of weeks out there in nat gas land. Intriguing stuff. Should be some fun action to parse out there. Before we do that, let's go to the dark side now, listeners. As we said, just an embarrassment of riches to choose from on the dark side. Number 5, oh, there it is, our other frequent offender. So the full trifecta in effect this week, listeners. Bitcoin coming in at number 5, so we're heading out to crypto here, off nearly 4% this week, 3.98%. Number 4, back to ags, KC wheat, off 4.33%. Number 3, it's palladium, back to the metals, off 6.4%. It was number 5 in the other direction last week, up 3.03%. Again, before you get excited, sub 100 contracts on the tape out there in palladium. Number 2, back to the ags, it is Chicago wheat, off 7.12%. Number 2 in the other direction last week, up nearly 6%. So intriguing couple of weeks, giving back more than it gained last week out there in Chicago wheat. And number 1 dark side mover this week, RBOB. So back to energy, off about 9.27%. It was number 3 to the light side last week, up 4.75%. Again, sub 1,000 contracts on the tape out there, so probably not a lot to parse. Rich, I love when you join us on the show because you always come armed with a whole bunch of data, a whole bunch of analysis, and some intriguing trade ideas. I know you've been busy in a lot of complexes, but I also know you've been diving deep into rates. A lot of people have a lot of thoughts on what's going on out there in the rates complex, so I think we're going to start there first.
The Fed, the yield curve, inflation fears. How are they impacting options activity and volatility in your favorite interest rate products? Let's find out as we explore the world of rates.
All right, listeners, welcome to the ever-evolving world of rates. If you want to find it for yourselves on the free reports, head on over to cmegroup.com/TWIFO. TWIFO. Once you're there, you're going to scroll down all the way to 2 from the bottom, to interest rates. And then from there, you're going to go into the U.S. rates products. And where we go from there, we'll leave it up to Rich. We'll let him decide. But Rich, you did just put out an interesting analysis, you can find it over there on the CME Excell with Options report over there at the CME Group website, listeners. Just a couple of days ago, called Accessing Deep Liquidity in the 2-year Treasury note. I thought that was interesting because, we talk a lot about the 10-year on this show and many other shows on the network. We'll talk about the 30-year. We get to some other areas of the yield curve. Very rarely do we talk about the 2-year. So first off, Rich, I have to know what made you decide to go there to look for your trade, and then what were some of your findings, sir?
Well, I'll tell you what made me go there is a lot of conversations I'm having with people who are thinking about how they can try to lock in some of these higher yields right now. And of course, we've saw in the last 9 months or so, a lot of money leaving bank accounts and going into money market accounts, et cetera. And they're usually, locking in kind of short term. But more and more of the financial advisors, et cetera, that I speak to talk about how they want to move a little bit further out to kind of lock in some of these yields. And obviously, you mentioned the 10-year, and the 10-year, given the shape of the yield curve, isn't really offering the same sort of yields that we're seeing in the short term. And so I'm hearing of talk of a lot more people moving into this 2-year. And in addition, we've seen a lot of the issuance side of it staying in the front part of the curve as well, and not going so much out further along the curve. And so to me, I was starting to look at and seeing supply and demand sort of coalescing around this kind of 2-year part of the curve, which I thought was interesting because it's right about where we see that kind of those high rates kind of start to tail off a little bit once we get beyond that.
Yeah, so a lot to unpack. And again, listeners, it's a pretty in-depth report. I encourage you to check it out if you are inclined. Again, Accessing Deep Liquidity in the 2-year Treasury note is what it's called there. But Rich, you kind of mentioned all that evolution. If you want to hit us with some other interesting findings again, this is a very, very detailed and thorough analysis. You always come to us armed with interesting trades, whether they're time flies or ratio, for all kinds of fun. So what fun did you get up to out there in the 2-year this week, sir?
Well, and trying to build on what I was just talking about on the supply and demand side of it, from a demand perspective, it's we clearly see individuals wanting to maybe lock in some of this risk-free rate, but on the flip side of it, another big source of typical demand for Treasury issuance comes from abroad, right? It comes from particularly like Japan and China, where that's been a big source. I think that's 35% of all foreign borrowers come from China and Japan, and that it's like 14% of overall demand for treasuries in aggregate from there. And what do we know that's kind of going on in those countries? Well, there's a lot going on there, right? The Bank of Japan recently adjusted its yield curve control, allowing rates to move a little bit more there, and we're seeing the currency weaken considerably. On the other side, we're seeing Chinese economic data slowing materially. The Chinese having to cut rates, but also seeing the Chinese yuan or renminbi weakening quite a bit. And interestingly, if you overlay the Chinese yuan and the Japanese yen versus Treasury yields, what you see is that there's a fairly tight fit. Now, I'm not suggesting there's correlation isn't always causation, but there is a linkage there, right? There's different things driving them. But because a lot of demand comes from foreigners, and they're seeing weakening currencies, that's driving their hedging costs up, which means that they need to demand a higher yield. And this is all happening at the same time, where you're seeing maybe some increase in demand from U.S. Retail accounts, but maybe a decrease from foreigners at a time when the Treasury is trying to refill the general account, and we know that there's quite a bit of interest. Quite a bit of need to issue, and that the Treasury report itself put out that they expect that the issuance here over the coming years about $1 trillion worth of bonds, which is obviously quite a bit. And so when we kind of put all this together, there's a lot of cross currents that traders have to deal with, right? And so to me, that naturally, I'm like, okay, when there's a lot of different things that could happen, and any one of them could drive things in certain different directions, I'm already thinking in my mind, I want to be long convexity, right? I want to be long optionality in some way. Now I kind of go in and I start to look in like, the tools that the CME group can provide, such as like the CVol tool, which lets us see where volatility is versus its own history, but also versus other products. And you can see that, the CVol, when I'm looking at kind of 2-year products and really across all the rate products, is very, very low. Implied volatility has been very low across a lot of products until very, very recently. But also the realized or historical volatility has been quite low in this product as well. And so, we don't have to go back very, very far. Even if you just kind of go back to March when we had that most recent kind of mini banking crisis, to see that we can see big spurts in realized volatility around those events when all of a sudden this supply demand, what looks like balance, somehow tilts one way or the other because there's a moving part that we're not anticipating. So I put all of this together, and I'm thinking about, okay, this to me looks like I'm not really sure which way this could break, but we've been kind of driving into lower and lower levels of realized volatility, and it looks like this could break one way or the other. And so I wanted to be long straddles, and I'm thinking about along those lines. It's the idea that the idea that low volatility is kind of the catalyst for high volatility because people get so comfortable with it, and therefore oftentimes will lead to people putting on more and more leverage. I think the Minsky quote is stability creates instability. But Mark, when we talk about long optionality, we always want to have a catalyst, right? Because long options are kind of an instant gratification idea, and so you don't want to just buy options because they look quote cheap or inexpensive. You want to buy them ahead of what we think are catalysts. And so what are some catalysts that might cause the supply demand balance to wobble a little bit? Well, next week we've got the Jackson Hole meeting, and then followed up in the middle of September with an FOMC meeting. And so while the market has kind of really coalesced around the idea that the Fed is finished, et cetera, is there something that could cause that to not work out the way we've expected? It was the Jackson Hole meeting last year with a very brief statement from Chairman Powell that caused quite a bit of volatility across all asset classes, and I think we've kind of forgotten that. But what would get the Fed to maybe tell people that it's not quite finished? And that's why I was looking at a little bit of the recent rise in oil and gasoline futures. I know that's come back a little bit here, but could this be causing a shift in inflation expectations? And we have seen a bit of an unanchoring of inflation expectations if we look at the 5-year, or if we look at the University of Michigan data in the 5-year level. And so, and where can I also see that? Well, CME Group provides another great tool, a cross-asset correlation tool. And when we look at that, what we see is what traders think in terms of the correlation of implied volatility of oil versus interest rates is at actually a reasonably high level versus where it is historically. And so the idea here being that unanchored inflation expectations might bring the Fed back into play, which might cause some moves in the rates complex, and that could ultimately be potentially triggered by oil. What might be triggering the oil? Oil is obviously supply and demand, and we know what we've been doing with the SPR here in the U.S. We know what OPEC Plus has already announced, but there's an interesting story I came across from the BBC that talked about how Ukraine has been using drones, to attack commercial vessels in the Black Sea, and how this is potentially going to disrupt the supply of Russian oil. And so that was another thing that maybe people aren't thinking about. And so that's what I was really kind of putting together and saying, I don't really know what's going to happen here, but I do know that we're at really low levels of implied and realized volatility. There's a number of different catalysts coming up of what we can see in terms of meetings. And then there's these other moving parts going on in terms of what's going on in Asian currencies, what's going on still in the Black Sea. And I just thought that getting long straddles made a lot of sense. And that's kind of where the whole idea kind of came from, Mark.
Yeah, this is fascinating. I was looking over the 2-year while you were talking, and it's been quite a while since we've sunk our teeth into the 2-year for obvious reasons. Looking here at the overall volume, it's about 35,000 contracts on the tape right now, so not exactly blowing the doors off, but not nothing either. It's not 1,000, it's not 500, anything like that. So there is starting to be more paper out there. I think maybe Rich, with you guys and other folks starting to talk about it, we'll see a little bit of a turn out there. I do love your straddle. I'm just looking at this, and it brought a smile to my face, Rich, and I know you pointed it out in your report as well. You were talking about the SEP straddle here, and so it has roughly 8 days to go, which is right past the Jackson Hole meeting, which I believe is next week sometime. So the vol out here, listeners, if you are intrigued, And again, we're talking about VIX all the time. People are always wringing their hands. Oh, VIX is in the teens. People start wringing their hands. Oh, vol is so low. They see a lot of the other assets we're going to talk about on the show have vol in the mid to low 20s. Sometimes if you get excited, things get into the low 30s. Nat gas hanging out around a 50 odd. And then you come into the 2-year, listeners. And the SEP contract, by the way, the SEP future and the 2-year, 101 and about a quarter, off about 6, almost 7 cents on the week out there. And the vol, listeners, 2.5. Yes, 2.5. It's up, though, up about a quarter of a point. So that's actually a size vol move. Rich, it's hard to even wrap my head around such anemic vol numbers. I mean, I know we're talking, usually the 10-year, you're talking a 7. So you're not talking explosive vol, pretty much, except for, the 3-month SOFR and the old euro dollars. It's hard to find a lot of vol in the rates complex, but still, a 2.5 puts it in a very special category. So I could see why maybe you'd want to go long that straddle rather than sell it, sir.
Yeah, absolutely. And it's a as you mentioned, it's a super low number. But let's look at, one of the things I highlight in the report is that the realized volatility of the 2-year in that March mini crisis shot up to 8 from 2. And so that's a massive move. And if you're long a straddle on a 2.5 vol and you get anything that approaches that, and some other crises we've seen post Jackson Hole last year, it shot up to a 5. And so that's a pretty big move. And so you don't have to necessarily play in the big numbers to make big gains. And I, said you could really, from a long side, you could look at it 2 different ways. You could look at it either from a break-even standpoint, where you buy the straddle and like say, I'm not really sure which way it's going to go, but these break-evens of kind of just above 101 and just above 102 look reasonably attractive to me. Or you can sit there and you try to delta hedge it on every day and just try to be disciplined and say, I think the realized volatility will go higher, and I'm going to just flatten every half an S standard deviation or every 1 standard deviation and try to make my money on a realized volatility basis versus a break even basis. But I think to me, it kind of set up to look at it from either perspective.
Yeah, aggressive delta hedging, 2-year straddles. I didn't think we'd be going there today. That's why I like when you join us here on the show, Rich. Always some intriguing ideas. So listeners, if you're looking for vol that is even cheaper than you may have expected in maybe an asset class and perhaps a portion of the yield curve that you didn't expect to be hanging out at, then perhaps you may be intrigued by the 2-year. Let's run down the rest of the 2-year action such as it is out here. I said about 35,000 contracts on the tape, a little over half, 57% of that coming in the SEP contract where Rich is hanging out. Maybe they read his report. That goes away in about 8 days. Like I said, the vol there is even lighter, 2.15 listeners. So yeah, these are impressively low levels of implied volatility. Skew such as it is when you have this anemic of a vol number, both sides were about roughly flat, maybe a point bid or offered in either direction. This week, the skew has evolved a little bit. The puts are slightly more bid, about 4% bid, and the calls 2% bid. So a little bit of a smile with a bias to the downside. I guess when you're looking at a 2 vol, a 4-point premium to the downside is actually something worthy of note. And what was leading the dance out here, listeners? It was the 101 even puts in that SEP future at a 101.1 right now. So these are pretty much the at-the-money puts. They went up 11,000 times. So again, the whole product did 35,000 contracts. So 11,000, nothing to sneeze at. The big day was Wednesday, 5,300, mostly opening there. 4,400 on Tuesday, slightly closing there. 1,000 on Monday, and then not much going up today. And then right behind it, we have the 101 and 5/8. Haven't said that in a long time. Puts going up. I should say expiring in about a day, a little over a day out there. They did 8,000 contracts, 8,182 to be precise, and of that, 8,160 went up on Wednesday. All of that opening. So folks piling into the 1 day to go, 101 and 5/8 puts out here on the 2-year. So fascinating stuff. I'll have to dig in to see if I see any size straddle prints for you here, Rich, but intriguing stuff nonetheless. We could probably sink our teeth into more out here for the rest of the show. But we got to keep on rolling, Rich, because I know you've been busy with a bunch of other complexes as well, including energy, which is also lighting up our movers and shakers this week. So let's head out there next.
It's time to tap into the deep options well of black gold, Texas tea, nat gas, and more. It's time to talk energy.
All right, everybody, welcome to the ever-evolving, ever-exciting world of energy. A lot of movers and shakers coming from the energy complex this week. A lot of action out there. Head on into that drop down, pop out of rates if you can drag yourself away from a 2-vol, listeners, and move up the chart a little bit to the energy complex. Then we're going to start. We have a lot of movers and shakers. Obviously, nat gas is dominating the tape out there percentage-wise this week. But we also have crude oil moving a lot this week, getting a lot of headlines, and also the subject of a report from Rich just a couple of weeks ago called, "Will Global Demand for Crude Oil Continue to Rise?" So, Rich, like we said, you always come armed with some intriguing data and also some intriguing strategies. What was catching your eye out there in terms of WTI with what's going on, the yin and yang of the OPEC cuts? Are they going to be enough? And what you're seeing from a vol perspective? And then what funky trade did that lead you into in WTI this week, sir?
Yeah, so oil to me and the oil complex has been really, really quite interesting. And I'll even highlight one of the light side movers we have when we talk about soybean oil, and a lot of people looking at soybean oil because of its use in renewable diesel and how it's actually correlated to oil too. And so oil has been kind of popping on my radar quite a bit. It's always supply and demand, right? And the demand has remained, global demand has remained remarkably consistent here throughout the year. And what's really for the last more than 12 months, probably 18 months, has been driving price has been the supply side, right? Last year, it was drawing down the SPR to 40-year low levels, and how that increase in supply in a relatively flat demand structure was causing prices to come down quite considerably from the high levels we saw early in 2022. Now we're seeing on the other side, we're seeing OPEC plus, they're cutting and they're sticking to these cuts. Is that enough? Can the U.S. has talked about refilling the SPR, but then we see the headlines that while they say they're going to do it, then that doesn't really get done. So what's going on there? We just mentioned on this report, or the other report this week, Russian supply. What do we think is going to be going on there? We've gotten data through earnings on North American rig counts, and that looks like it's those are starting to slow down quite a bit. And then there's some other headlines about Pemex in Mexico that lost over 100,000 barrels a day to a fire that they had. But if you look into their data, what we've been seeing is that their output has been slowly decaying for quite a long time because they've been losing expertise. And so it's starting to look like the supply side here is really starting to wane. And then if the demand stays constant as it has, what does that mean for price? Now, in the report, this was a few weeks ago, I was talking about Chinese demand. There's a lot of expectations for more and more Chinese stimulus in the second half of this year. We've seen some elements of that, but we've also seen some really poor data from China as well. And so that's a variable we have to kind of think about. There's like I said, there's still expectation for a lot of stimulus. Could that bring demand up a little bit further as well? And so that's that was the backdrop that I was really kind of thinking about. And then, as always, my next stop when I'm kind of parsing through all of those stories and macro stories, et cetera, is I go to CVOL. I'm like, okay, is volatility generally expensive or generally inexpensive? And how is that going to form my opinion? And you look like just about every product, CVOL levels for not just oil but across the energy complex is fairly low across the board. And you can dig into those CVOL numbers and you can look at up VAR or down VAR and or the difference of them, or you can look at skew. You can get a good measure of skew. And what we've seen is that on the skew side, there's the skew you can see where there's a preference for convexity from the traders. And we've seen that when prices shot up in early 2022, skew moved up quite considerably. But at this point, skew is pretty flat. And if anything, we still see some preference for downside options versus upside options. And so, looking through all of that, I'm thinking, okay, I want to generally be long optionality. I want to be long options to the upside because it feels like if we're going to get a move, it's going to be a move to the upside. How can I take advantage of this skew being steepest, if you will, the further out you go, and kind of price this up? And what's the market giving me, given the backdrop that I'm seeing right now? And so I wanted to kind of do a little bit of a skew trade which is, of course, puts versus calls. But I wanted to make this a little bit of a directional trade that was net long volatility. And so that's where I came up with a calendar idea where I was selling in the money calls and using that money to buy shorter term upside options. So I was selling in the money 75 calls and then using that money to buy 3 times the number of shorter dated upside options and giving myself basically a long convexity profile that if I got a pop in this on a move higher here, I was going to move into a lot of long optionality and be able to kind of trade that. If instead these catalysts played out and we saw a move lower in oil instead, because I had sold this in the money option, I was actually and took in some premium. If the whole structure of the whole complex moves down over the life of both of those options, I would actually make some money at this point. So it was actually, to me, a structure that was a net long bias structure that did better than just being long futures, because I had an opportunity to make money on the downside, even if it didn't play out directionally as I was thinking it would play out, which is a move to the upside, if that makes sense.
No, a lot to unpack there, which is fascinating. We don't see these types of ratio trades in the energy too often. We see them in products like VIX, right, which are obviously known for their explosive upside. And even then, we haven't seen them as frequently as we did a couple of years ago. They're starting to make their way back in now that VIX has retreated from some of its loftier levels out there. But intriguing stuff. I like all of this. Again, listeners, if you want to check it out for yourselves, and I encourage you to do that with all of these, because there is a lot of data here, a lot of visuals. If you're a visual learner, it's a good way to go. The report is called, Will Global Demand for Crude Oil Continue to Rise? Let's get out to WTI and see if it's rising or falling, at least from a volume perspective. The underlying falling right now off nearly 3 handles, or about 3.4%, back below the 80 handle in that front future, if ever so slightly, 79.75 right now. But surprisingly light on the volume front. Again, it is August, so we would seasonally expect these lighter volume levels, but then again, things are popping. We were just talking on our Option Block show about how VIX and all these other things that are usually in their seasonally light period heading into the dog days of summer are putting up record numbers. So I wouldn't be surprised to see WTI participating. Doesn't seem like it is right now. 300,000 contracts. Usually this time of the week, we expect anywhere from 400 to 450. So looking kind of light, actually, on the volume front. And most of that paper, nearly half, 44%, coming in the October contract, which has about 29 days to go. So we're going to sink our teeth out there. What is the vol? You might be wondering. It's a little bit higher than a 2. It's about 28.5, up about 2/3 of a point. So again, energy complex, if you're looking for some volatility out there across all the assets on CME, you could do worse than sink your teeth into the energy complex. You know, nat gas, obviously its own beast, but WTI, respectable, near a 30. We all know crypto even dipping to levels like this now. Crypto, usually a good bastion of volatility. It is in the mid to high 20s in ETH and Bitcoin right now as well. So kind of hard to find a lot of juicy vol out there. So energy is kind of one of your few places to go. Well, let's go out to the skew, see what's going on out there. Last week, the puts were where the action was, 7% bid. This week, the puts are still bid, but not quite as aggressively, 5.7% bid. So coming in a little bit. The calls are kind of unchanged. They were 4.2% cheap last week, 4% cheap this week. So that, again, shows you kind of what Rich was talking about with the skew and where the bias is. It is to the downside, if ever so slightly right now. We have kind of a modest equity skew, I would call it out here. If we were looking at this from an equity, the puts would be more bid, the calls would be more offered, but we're trending in that direction, listeners. And in terms of the action, where was the action? I said we just dipped below the 80 handle out here, listeners. It was the 90 calls in October leading the dance. It seems like folks were getting the heck out of Dodge on these all week, which probably also contributed to that light call skew out there. The big day, actually Tuesday, about 4,000 on Tuesday, 2,000 each Monday and Wednesday, closing pretty much all of those days. 3,600 today. Obviously, we don't know today, but I'm going to guess probably bailing out there today as well. Right behind it, we had the 85 strike. It lines up pretty close, about 11,500 versus 11,800 for the 90s. Actually, volume-wise, some days it looks like it could be a roll. But it looks like they're closing here on the 85s as well, though. So it doesn't seem like folks were rolling from the 90s to the 85s. It seems like they were just getting the heck out of Dodge on both strikes. The big day for the 85s actually today, 4,300 today, a 3,500 on Tuesday, 3,000 on Wednesday, only 500 on Monday. So it looks like closing Tuesday and Wednesday out there as well. So folks just bailing on a ton of upside here in WTI, and given what we're seeing out there, maybe it's understandable. Right behind it, we have the 75 puts. So there are some puts sneaking into our top 5 this week, which is more along the lines of what I expected out here. We have about 10,600 of the October 75 puts going up this week. The big day Tuesday, 4,100 on Tuesday, 2,000 on Monday, 3,000 today, and about 1,500 on Wednesday. Seems like they were opening all week long. So again, makes some sense as we continue to threaten that 75 handle, get closer to it. More opening on that 75 put strike out there in October. So funky stuff. Before we roll on energy, we have to touch on the big dog mover of the week, at least percentage-wise, for our movers and shakers report listeners. That is one of our frequent offenders, which is nat gas. Like we said, dominating our upside movers and shakers, dominating the whole report this week, up 17%, 17.37% a week over week. That's coming on the heels of being up nearly 9%. So nat gas popping. Given some of that back right now, it's off about 14 cents net so far this week. So giving some of that back, but a banner couple of weeks. Mr. Rich, I know you've been focusing a lot on the WTI side of the energy space, but anything catching your eye in the ever turbulent world of nat gas these days?
Yeah, nat gas was something that I've written about a little over a month ago, going back or probably into maybe late June. And that was something where, and I think we talked about last time I was on, where we had been consolidating at a fairly low level and started to move higher. And to me, technically looking like it was about to maybe potentially break out. It's a similar sort of situation in some ways to the consolidation we've kind of seen in some of these rate futures products as well. And so to me, those are always interesting places when you see a long consolidation. You know it's not going to last forever, but which way is it going to break? And that was something we kind of had explored at that point. So this nat gas, especially, we know the kind of the seasonality, et cetera. And, at the time I was looking at also the kind of the buildup, the approval of LNG, liquid natural gas plants that was happening, and the fact that Europe had to stockpile going into the winter. There are some interesting global dynamics going to go on that were going to be potentially impacting U.S. nat gas too.
Let's get out there and see what is going on from a nat gas impact right now. Like we said, off about 14 cents this week, so giving up some of the ghost, off about 5.25% since Monday. Of course, you go back to the end of our show last week, a little bit of a different percentage mover. And of course, it's easy for an underlying that is around $2.62 to be our percentage gainer and loser of the week. So read into some of those leading numbers with a bit of a grain of salt, but it is fascinating. I know for a lot of you, it's a big product on your radar. Now, that is, again, evident by the volume numbers. Usually, kind of like WTI, we expect somewhere around 450,000 contracts this time of week. WTI shedding volume, I guess they're picking it up here in crude oil, in nat gas, because nearly 600,000 contracts on the tape right now for nat gas. So a bit of a banger week out here. And where is the action, listeners? Nearly half, 47% of that paper going up in the October contract as well. It has about 40 days to go. So we're going to head out there. And, vol getting juicy again out here in nat gas. We were hanging out at a 50. In fact, if you look at the September contract that has about 11 days to go, it still isn't a 50 handle, 59 to be precise. We get a little bit longer term, though. We go out to October, 40 days. Now we're threatening a 70, 67, 87 right now, up about 5 2/3 points. And that's starting to get closer to the type of vol we expect from a nat gas. When you're hanging out in the 50s in nat gas, that's fairly anemic from a vol perspective. And again, we've seen nat gas get into the triple digits very easily. So 50 handle vol in nat gas, it's certainly intriguing. It's not quite a 2 handle like we saw on the 2-year note, but it's maybe the nat gas equivalent of it, listeners. In terms of a skew, interesting, kind of a quiet skew last couple of weeks, which is interesting. Last week, the puts were 3.5% bid. This week, they are 2.6% bid, so not a heck of a lot of premium really there. And the calls last week, 1.4% cheap. This week, 0.3% bid, so effectively flat. So intriguing. This skew is kind of showing me that it's a bit of a coin flip right now in terms of what the options market is expecting, at least through the October expiration. You go a little bit farther out, you see a little bit more bid to the puts. You go out to, let's say, June of next year, and now you're seeing about a 6% bid. Even that is not terribly aggressive. So it seems like the skew may be settling down. By the way, the October futures at about 275, listeners. So intriguing stuff out there. Maybe this is the level where folks are starting to say, you know what? We've dipped below, threatened the 2.5 level. We've rallied, threatened the 3 level. Seems like 2 3/4 may be a good settling out point, at least for right now. What is interesting is the number one volume leader out here in nat gas this week, listeners. We haven't seen strikes above the 3 handle. Obviously, we saw those strips, the weird strips with like the 6 calls, but those are kind of an aberration. I'm talking about size prints. We haven't seen a ton above the 3 strike lately. That is changing this week. The 3.5 calls in October leading the dance this week with 34,000 contracts. So a lot of action in these 3.5s and back and forth, opening to closing too. So a lot of back and forth trading out here. The big day is actually today. 12,000 today, almost 11,000 yesterday, 6,000 on Tuesday, 5,400 on Monday. So heavy action pretty much every day this week in these 3.5s, back and forth, opening to closing throughout the week. So a lot of churn and burn on these 3.5 calls. Right behind it, we actually have the 2 puts, nearly 30,000 of those, also in October. The big day for those, Monday, about 12,000 on Monday, mostly closing there. Then 7,500 today, 6,400 on Wednesday, 4,000 on Tuesday. So closing looks like the rest of the week. I should be opening the rest of the week on those 2 puts and then closing on Monday. And then we stay with the downside. We go to the 2.5 puts. This is the kind of paper we've come to expect now in nat gas. You know, the 2.5 puts, the 2 puts, that sort of thing. The 2.5 puts this week in October doing 29,000 contracts. The big day for those today. So the liquidity is kind of all over the place in these, which is interesting in and of itself. 8,500 on Wednesday, slightly opening there. 7,000 on Tuesday, slightly closing. And then 4,500 on Monday, slightly opening again. So back and forth on the 2.5 puts and on the 2 puts and on the 3.5 calls. And if you want some more calls, how about 27,600 of the 3 calls also going up this week? The big day for those also today. Nearly 13,000 going up today. And then the rest of the week was all closing. 7,000 on Wednesday, 6,500 on Tuesday, 1,500 on Monday. So folks maybe bailing on the 3s as we continue to move at least to the dark side here. This week, of course, net from our show last week, a little bit of a different story. So fascinating stuff. I'm just scrolling around here. If you're wondering what is this week's strip, listeners, it is the 4-call strip going up pretty much from April all the way out to the end of the year next year, going up 1,020 times. I love the size that goes up in these things. It's so head-scratching, but that's where we are this week. Again, so we hit on energy, we hit on rates. We got time for probably one more complex, Mr. Rich, before we get to some of the listeners. So where do you want to hang our hat next, sir? I'll let you choose.
Well, you know, I probably would say ags would be a good place to go. There's a lot of good movers there, as you mentioned, or at the start of the show. All
right, then to the ags complex we go, listeners.
It's time to get our hands dirty exploring the latest options, trades, and trends in corn, wheat, soybeans, and more. It's time to talk ags.
All right, listeners, welcome to the world of ags. You know where to find it. Go into that drop down. It's right at the top of the list. It is an alpha order list after all. And Rich is not wrong. A lot of frequent offenders out there in the movers and shakers this week coming from the ags complex, almost the entire light side. We had lumber, we had soybean oil, we had oats, we had Class V milk on the light side. To the dark side, we had Chicago wheat and KC wheat. So quite a few of our movers and shakers this week coming in the ags complex. Mr. Rich, I know in the past you've come on here and talked about time flies and some of the ags. What's catching your eye? Which products are catching your eye out there in the ags complex this week, sir?
I would say the 3 that I'm generally trying to keep my eye on are soybean oil, wheat, both Chicago and KC wheat, and lumber, but for really, really kind of different reasons. As I mentioned before, soybean oil, this and potentially has some interesting leading properties, perhaps, of oil, but certainly tied to it, given, like I said, the renewable diesel demand. So, we talked a lot about oil. So what are we seeing in soybean oil? Is that kind of a move that's worth paying attention to here? Wheat's interesting for a different reason. Talked a little bit about what's going on in the Black Sea we saw the collapse of the Russia-Ukraine wheat export deal, and we had a pop in wheat right on the back of that. But it's given up all of that and then some. And so to me, it's always interesting when you see prices not respond the way you'd expect around a kind of a news event like that. Was that perhaps maybe there's a little bit too much anticipation of that? And so that's what's really caught my eye. And then lumber for another different. Obviously, a lot of people are talking about housing, talking about mortgage rates, talking about even Warren Buffett buying home builder stocks or whatever, and all of the potential optimism or pessimism, depending on where you're coming from, in the housing complex. But lumber is just not showing us the love, is it? It's really kind of low and staying low, and even though it's kind of a move on the light side, it's coming from low levels. And so, to me, that's always a good leading indicator of what we should be expecting in the housing market going forward. And so, what is that going to mean for the economy and for other products too? So, a lot of different moving parts going on, as you said. Some things are on the light side, some are on the dark side, and they're each with their own catalyst. So, I thought it was just a really interesting place to be looking for things.
It is a fascinating complex. We could easily do the full hour in the ags as well. Listen, you just ran down a lot of the interesting products. We mentioned Chicago. We've talked about that a lot recently on the show. Doing decent paper this week, 122,000, but a product we haven't touched on in a while. Number 3 light side mover this week. It is soybean oil, up 5.25% since our show last week. We're going to head out there. Decent paper out there this week as well. 73,000 contracts on the tape for that. Where is soybean oil? You might be wondering right now. 67.75 in that front future, up about 3.6 or about 5.64% just since the Monday show. So pretty much most of that move to the upside coming this week. And of that 73,000 contracts, about 60% going up in the SEP contract that goes away in 8 days. So very near dated, not quite 0 day, but about as close as you're going to get in the soybean oil contracts out there. So we're going to hang our hat out there, listeners. Usually we wouldn't do that. Usually we'd say, try to keep it outside of 2 weeks. But, in this era of 0 day, listeners, you got to get as close to the fire as possible, it seems like. Right now, the vol out here in soybean oil, a 30.62, up about half a point. So interesting out there. So not too many assets we're going to talk about on CME right now, north of a 30 from a vol perspective. This is one of the few you can sink your teeth into out there and getting a little bit frothier this week. Skew-wise, not much evolution. The puts were 3.8% bid last week, 3.7% this bid this week, so not much going on there. The calls, 0.4% cheap last week, so pretty much flat. This week, getting a little bit cheaper, about 2.1% cheap. So, again, kind of a modest bid to the puts and an offer to the calls, but nothing crazy out there. And in terms of action, the big dog out here, I said we're at a 67.75 in that front future. It was the 63 even puts leading the dance out here this week, doing 7,300 contracts. The big day was Wednesday, 3,200 on Wednesday, 2,100 today, 1,600 on Tuesday, only a couple of hundred on Monday. Mostly closing on Wednesday, opening on Tuesday. Seems like a lot of back and forth on these 63 puts. And then right behind it, we have these 66 calls. So a pretty tight strangle or risk reversal, call it what you will, out there. These calls in the money here, 4,500 of those. The big day for those was Monday, nearly 3,000. So a lot of folks bailing on the 66 calls on Monday, obviously. About almost 800 on Tuesday, almost 1,000 today. Nothing to speak of on Wednesday. So it seems like a lot of folks bailing on Monday, then some slight paper coming back in throughout the rest of the week. And then right behind it, we have to go out a little bit to the 63 calls in December. They did about 4,000 contracts exactly this week. And for that one, the busy day, not Monday, but Wednesday, 3,100 going up on Wednesday. The rest of the paper kind of scattered throughout the week and not much to write home about. So it was all on Wednesday, and it was all folks bailing on the 63s. Maybe they rolled up to the 65s because we have about 2,300, total of 3,500 of the 65s trading on the week and about 2,300 going up on Wednesday, mostly opening. So maybe a bit of a roll there from the 63 to the 65 calls here in soybean oil. But we are coming up against it, listeners. I want to make sure we get to some of you folks. So a little bit of your futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/theoptionsinsider, stocktwits.com/optionsinsider, or via questions@theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, everyone, welcome to the Futures Options feedback segment. No shortage of ways for you folks to interact with us here. Of course, at Options on most of your major social media platforms is an easy way to get at us. Questions at theoptionsinsider.com also works, of course. If you're in the secret club and you're listening live, we always bump those to the top of the list. Rich, seems like a lot of our secret club members, we're happy to have you back. We have Option God here in our chat saying, happy to have Rich back on the show. Always has great trade ideas. And you also spurred a good conversation about trading the 2-year note in our chat, Rich. So you're getting our chat up to no good. You're luring them to the dark side of the 2-year note, sir.
That's always good to hear, actually. It's good to just generate some interest and get people talking about it, right? Maybe there's a trade there, maybe there's not. I think there might be, but at least we're talking about it and exploring new ideas.
Yeah, a few of them saying they have traded, others saying they've looked at it, but not a lot of volume yet. It's kind of kept them away. I understand that, but it is starting to grow. So I guess if you're a little bit diligent, not scared to maybe work some of your orders, then the 2-year could be a viable option. Hey, it doesn't get a lot of love. Everyone talks 10-year, maybe 30-year. Not a lot of love for the 2-year. So there you go. We've got Age Del Aquarius says, while I'm a secret club member, it is amazing that Options Insider gives this content away for free. You can learn more here than an entire day listening to CNBC. And then Options Queen chimes in. She says she agrees. Definitely get more trading info listening to Options Insider than anywhere else. Not a fan of CNBC. Well, thank you to all of you folks out there. You are very generous with your praise. We do think we do a pretty good job here. We have been doing it for quite some time. I think there's a reason we've been around and kind of the standard bearer in this space for 16 plus years. So I think we do a pretty good job, but it's always nice to hear that. So thank you to you folks out there. And if you're on the fence about listening, maybe you're listening now for the first time, you're one of our newer listeners, maybe that'll convince you to join the dark side and at least subscribe to the full network. And who knows, you get excited, you get interested, maybe you join some of our cool cats and kittens over there in the secret club. And they are a pretty fun and pretty nice bunch. Our one rule for secret club, no jerks. It seems like we're able to adhere to that rule pretty well out there. So a lot of love. Thank you for all that out there, folks. Let's get to our question of the week this week. Let's see what kind of love or perhaps lack of love you guys have for this market and these products. Rich, I want to get your thoughts on this as well, because you're always looking at a wide variety of assets. At the beginning of the year, we always ask our audience their sentiment for the year. We give them a bunch of different asset classes to choose from. We say if you had to buy a 10% out of the money call expiring at the end of the year in one of these 4 asset classes, which one would you choose? When we ran this the first week of January, the choices, by the way, were the S&P 500, Bitcoin, crude oil, or volatility, aka VIX. 43% of our audience chose the S&P 500. Not a bad choice. I have to run the numbers to see year to date how that's working out. Obviously, Bitcoin had a nice run earlier in the year, kind of treading water, giving some of that back. Now, VIX had some interesting movement, so haven't crunched the numbers, but obviously the S&P doing all right this year, so not a bad choice. But we asked him again. We thought it was a good time to revisit that question, Rich, now that we're coming in on the latter half of the year here. Quite simply, again, and you have to hold it till the end of the year. This is buy a 10% out of the money call, listeners, and hold it through the end of the year on one of these following categories, the S&P, Bitcoin, WTI, or VIX. Which one would it be? Mr. Rich, what is your vote? And then B, what do you think our audience is up to, sir?
That's a really good question. I mean, going down the list, SPX to me had, like you said, we've had a nice move already this year. Could we get another 10% plus to where that would go in the money? I'm not so sure of that, so I don't think I'd choose that. Bitcoin and crypto in general has just been kind of boring for the last 4 or 5 months, which is, you normally can't say that about crypto. And so it's kind of hard really to get excited there. Maybe we're breaking this boredom on the downside. VIX is one where, that's one that's such a high volatility. And if you don't get the move, in such a mean reverting product, you're going to see a lot of time decay. So I think I would vote for WTI myself. I do think we're going to see this kind of move higher in crude over the course of the year. I think we're going to continue to see supply disruptions and still steady demand. So I would personally vote for crude. But I'm going to guess a lot of listeners were probably picking Bitcoin, would be my guess.
Interesting stuff here. Let's get out to the numbers And for a while there, Rich, it was exactly mirroring our January poll, with 43% of the people choosing the S&P 500. That has since changed somewhat. The S&P still in the lead, though, 37%. So I guess they're seeing the past is prologue, Rich. They had an up first half of the year. They expect it for the second half, followed by then it becomes more contentious with your pick, WTI, coming in at number 2, 29.6%. Volatility itself, 25.9%. Again, you're talking percents of percents. I know that drives some people crazy, including the greasiest of meatballs on our platform. But VIX can do 10% in a heartbeat if it really wants to, right? But then the question is, can it hold it through the end of the year? So a lot of questions there, but 25.9% of you choosing the VIX. And then, Rich, maybe surprising, only 7.4% choosing Bitcoin. You're right. Maybe some of the recent malaise out there is impacting people, because Bitcoin's another one. It can do 10% in a heartbeat, pretty much overnight if it really wants to. And yet the last couple of months, it's kind of been meandering around the 30,000 level. And maybe that's taken some of the steam out of it, because only 7.4% of our audience choosing Bitcoin, Rich. Does that surprise you?
It does. It does surprise me. So I obviously got that one wrong, but I don't know. Maybe it's, like I said, maybe there's a little bit of boredom, but there's been some interesting headlines in Bitcoin, and maybe it's along the same lines as what we saw with wheat. If we're not getting the move we would expect on some of these headlines, maybe it's time to go the other way. I don't know. Interesting.
It is interesting indeed. Unfortunately, that music means we've come to the end of the interesting info, at least here on TWIFO, listeners. If you missed anything we talked about here on the show or anything else we talked about this week, check it out, of course, on the full podcast feed. If you haven't subscribed to the full network, what are you doing? As our listeners say, you're missing out on a lot of great stuff that we give pretty much the lion's share of it away for free, and have been doing so for 16 plus years. So if you like what you hear, throw some stars, a rating, or a review. It does help new folks continue to discover the content. And of course, if you want to join all the cool cats and kittens over there in the secret club, theoptionsinsider.com/pro, the place to go to learn more. And Mr. Rich, you came armed once again with a lot of great nuggets for our listeners. If folks want to keep up with everything you're putting out over there in between your appearances on the old network, where should they go? What should they do?
Well, you can always get me at CME Group. You can find the Excell with Options posts there. They come out bi-weekly, so that's a good place to start for sure. I'm on Twitter. I guess they call it X now. Whatever it's called, I'm there at Excell Richard. And I'm also on, hit me up on LinkedIn, and I'm on Substack as well in a post called Stay Vigilant. So always putting out different content on different things, but there is a string that kind of weaves them all together. So if you enjoy the Excell with Options, you might enjoy the others as well.
I can't call it X either. It's going to be Twitter for me forever. Of course, You were ahead of it. You have an X in your handle at least, so you can maybe get behind some of the X branding. Yeah, check them out.
My CME badge was XX. So
was it?
I definitely can get ahead of it.
You definitely can get ahead of that then. And you like FX. So, yes, you live in the world of X. Maybe Professor X's School for Gifted Youngsters is in your future, sir. Intriguing stuff there. Of course, check them out over there on the CME website, Excell with Options Report, and Stay Vigilant over there on the old Twitter/X, even though we don't call it that. That is going to do it for us here on the network today. Back again tomorrow, noon Central, 1 p.m. Eastern, for Volatility Views. It's going to be an interesting one, breaking down a week's worth of volatility. And then back again afterwards for all you Secret Club members with Options Oddities. Going to be a fun one there as well. A lot to parse there. And then back again next week with the Option Block on Monday all the way through to next Thursday. Another episode of This Week in Futures Options. Stay safe out there, everybody.
This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.